Good morning, everyone. I'm Tara Gillam, Services Innovation Manager at Business West, and welcome to our autumn webinar and thought leadership series, Innovate 2021, Overcoming Challenges and Building for Growth, supported by Business West and Innovate UK. This series of webinars is running every Tuesday morning throughout the autumn, covering topics from IP, design thinking, funding and finance, leadership strategy, and sales and marketing, as well as promoting the wider bespoke support available from us and how we can add value to your future growth plans in this challenging environment. Today is our 10th webinar in this series and the second of two webinars covering business strategy. Today's webinar is titled Business Strategy Part 2, Optimising Stakeholder Value, and is delivered by one of our expert advisors, Phil Tellwright. As a participant of Innovate 2021 and subject to Innovate UK eligibility criteria, there is the opportunity to access our comprehensive range of business support services, which includes business strategy advice. I will discuss the next steps on how to access these services at the end of the session. Now, before I hand you over to Phil, there is just a bit of housekeeping I'd like to talk through. If you have a question you'd like to ask, which we will facilitate at the end of the webinar, please use the Q&A button at the bottom. We will be moderated, or that will be moderated throughout. If you want to communicate with other attendees, use the chat button at the bottom. If you have any problems at all, technical problems throughout, raise your hand and one of us will come to your assistance. For on demand, this webinar is being recorded. Your personal video and microphones will not be used unless invited by the host. Now on to our speaker today. Over the past 30 years, Phil has held senior positions at leading Southwest businesses and was instrumental in the creation of Swain, the UK's most successful regional business angel network. Although an accountant by profession, Phil's main strength is his creative approach to developing and delivering value-creating support to business clients. Phil is a qualified business coach and has previously worked with Innovate UK to deliver strategy workshops on scaling rapidly. So without further ado, I'll put you in the capable hands of Phil.
Morning, everybody, and very pleased to be with you for a second time. So here we are, same bat time, same bat channel. I thought I'd begin this session with a little bit of a reprise of the previous one. It is by no means a full review, but of course you can always get access to what went before. So we looked at the broader aspects of business strategy. And the key word here in this definition is the continuity of creating, delivering and capturing value. And the reason that that's important is because the only thing we know is going to remain the same is that things will change. They always have and they always will. We talked about the fact that management teams can actually only affect probably about 20% of the influences on a business. We went through it in some detail, but it's really quite scary to consider the things that happen in the marketplace with technology, legally, regulatory wise, that management just can't do anything about. So we're trying to steer a ship with a very small rudder in a lot of cases. We looked at an example of Whitbread, which is a business which has reinvented itself to manage change and has done so very successfully. It's still in the FTSE 100. And we looked at Tesco's abortive attempt to open a grocery store in the west coast of the States, and managed to romp up losses of about 1.5 billion, which ain't bad in about 5 years, bearing in mind that they already know a little bit about selling groceries and foodstuffs. We began to think a little bit about what a psychologist would call theory of mind, and essentially being able to put yourself in the shoes of another person. And I introduced this little idea, which I'm going to develop a bit today, of the 3 different perspectives from which an item can be viewed. Now, the shape on the left, on the right rather, is a 3-dimensional model. You get a rough idea of its shape. But the interesting thing is that if it was sort of floating in the air and it was suspended and it was viewed from 3 different angles, the shadow that it showed would be completely different. Each of the viewpoints would convince the viewer that they were actually seeing what was in the middle. You would never persuade the person who's looking at the blue image that this was not a ball or a spherical shape. Similarly, the person looking at the green shape is convinced that the floating item is a triangle. In fact, they're all right. They're all correct. They just don't see things from the end. They don't get the entire picture. We introduced a framework. Back to this. If any of you raise money from a VC or anything like that, and you have due diligence done on you, they will be looking out for the differences in approach and opinion between maybe the CEO, the CTO, and the marketing guy. They will have a different perspective, and the question is, are they all on the same page? Do they all have a congruent view of where the business is going? I suggested that if you were looking to put a strategy together, you could look at 4 key sectors. I suggested that you could look at the larger scale side of things, the smaller scale side of things, you could look at the market, and you could look at the industry. As far as market attractiveness is concerned, we talked about a number of things, but we really looked at Ansoff and the ways in which a company could develop. We looked at market share and we looked at pestle analysis. As far as industry attractiveness was concerned, we looked at sustainable advantage and Michael Porter's 5 forces, which many of the investors I know still use as one of their entry points. We looked at sustainable advantage and a business model. This is one, possibly the most famous. This is the business model canvas, which was developed by Alex Osterwalder and still remains to this day very much in Innovate's thinking. Ash Miura produced another one, probably more aimed at technology businesses, probably more aimed at early stage businesses. And that was sort of where we finished. We didn't look at the 4th sector, which John Mullins, who came and gave some very interesting talks to the Swain investors. He's Professor of Entrepreneurship at the London Business School, and his book about the new business road test had this phrase, "Will the fish bite?" In other words, at the micro end of the market, why is it that somebody is going to part with cash? So on to the development slides in part 2. I think the simplest way to look at this is again through an Osterwalder model, his second book. about a value proposition. And what we have here on the right, the circle is all about the customer who is in the middle. And the concept is that the customer has a number of jobs to do, not jobs in the sense of employment, things that they want to achieve. On the left-hand side, we have the company, the service deliverer, the product manufacturer, who devises products and services aimed at this customer, aimed at really satisfying these needs. And the point of the story is that this can be done in certain ways, which might be considered to be gains by the customer, and it might have shortfalls, and they might be considered to be pains. The job of the company is to deliver the service in such a way that they create these and they relieve these. Just to put a little bit of an example on this, if you take the instance of somebody wanting to get across London and possibly considering a taxi ride or the tube, what is their job? Well, their job is to get from A to B. As far as the taxi provider is concerned, or the person developing the service and looking at this customer whose main job is to get from A to B, what things would make this a good service? Well, amongst the things you might suggest are that you would know how much it cost, the taxi would be clean, the taxi driver would know the way and allow you to arrive on time. Another gain is that you might be able to find a cab, which in normal times you wouldn't be able to do at 10:30 on a Saturday evening in the West End. All sorts of reasons why these would make the taxi ride more pleasurable and satisfy the need. And you probably guess where we're headed here, but what somebody came up with was the concept of Uber. Other brands are available. And interestingly, these gains were created for our customer without this organization owning a single cab. The business model was built around the satisfaction of the customer's needs. And a great number of potential purchasers, investors, financiers begin their evaluation of a company by trying to understand exactly what it is which the business is trying to do for its customer. Just develop this one more slide. This many of you will recognize. In fact, those of you with sharp eyes will see this is a Harley Davidson. And the question I pose about this is, who do you think Harley Davidson consider to be their biggest competitors in the States? And when I've asked that at workshops and similar, people scratch their heads, and then some people say, well, Honda and maybe Yamaha. And one of the answers, a big part of the answer, is in fact that Harley Davidson consider that infinity pools and conservatories are amongst their biggest competitors. And that's because when people buy a bike like this, at least when many people buy a bike like this, the job they are trying to do is to impress their friends and their acquaintances. They want to invite people round to a nice party at their place, and they're going to put the Harley at the top of the drive, And as everybody arrives, they're going to say, wow, aren't you cool? Aren't you hip? You've got a Harley. The guy never intends to ride the Harley very far, but it's there purely, in many cases, to impress his friends. Now, those friends can be impressed to a similar degree, perhaps, if he installs the most fantastic infinity pool, or maybe he just builds an out-of-the-world conservatory. When it comes to product development, there is a further level to this, because if you were conscious of the need that was being satisfied, how would you improve this? Would you make it go 20 miles an hour faster when the guy doesn't actually ride it at high speed across Nevada? Or maybe would you put gold handlebars on it because it's more bling and it actually improves what he's trying to achieve by impressing his friends? So I would suggest that there is more to this simple document than perhaps at first meets the eye. And when looking at value propositions and what people are doing for the customer, think of the Harley. There's a guy called Steve Blank, and he wrote a book. I've got a number of books to recommend. I'll pull it out in a second. And he developed what he called the customer development process. And it's whereby, in terms of searching for a new value proposition, there is a customer discovery process and then a checking to see whether the concept will fly. And this word that we see all the time these days, people pivot, because when you check out whether customers will actually part with cash, maybe they're not interested in what you think they are, and so you go back to customer discovery. Once you've gone through this phase, the search phase, successfully, there is then an execution phase. I do recommend this book because it really is all about how you get from a problem solution fit, where somebody thinks there's a problem and then comes up with a solution, to what Blank describes as a product market fit, which is ending up with, as it suggests, a product which will sell in the market. I'm very aware that there's a wide audience looking at this. Some will be existing in existing businesses. Some will be looking to start up. Ash Mayora's second book, which is called Scaling Lean, introduced this concept of a customer factory and more aimed perhaps at technology businesses, looking at, and what he's saying is the thing which a company needs to develop most is traction with its customers. So it's really all about how customers are acquired, how they are retained, and what makes them happy. How do you hang on to them? And he suggests that it's the rate at which customers are acquired and transformed into ongoing returning customers that should be measured. There's no point in a startup in measuring revenues for the first 6, 9, 12 months. Perhaps there are really no numbers to look at. All we're doing is monitoring spend. So when we have a board meeting, if we can't really have a meaningful discussion about the spend, what are we going to measure? And Mayora's book is a very good insight into this. And the reason this is relevant to existing businesses is that, of course, they should be continuing to develop new ideas and new products. So, building shareholder value. Sorry, it's a bit of a busy slide, but what might somebody be looking at to see if a business was successful? Top one, demonstrable execution of business model to date. What have they done? Let's say that you are looking to sell a business, and in many ways, building an exit strategy is a very good way to see how shareholder value is being created. Imagine a sale in 5 years' time. Imagine a purchaser comes along and starts looking at things. Now here, this perspective is the owner. Oh, wow, it's fantastic business. It's given myself and my family a real good ride for the last 10 years, draw a big salary out of it, get some dividends as well. My son's employed in it, my daughter's employed in it. I've got, excuse me, I got 2 BMWs in the drive. I have 3 holidays a year. It's a fantastic business. Purchaser looks at things slightly differently. He's not buying necessarily what the owner is selling. What he's buying is what is going to happen when he acquires it. And that is far more about the future than it is about the past. So if we go back to the top thing, demonstrable execution of business model to date, yes, it's important to look back. It's important that the owner demonstrates that this business has been able to spin off profit and cash. But it's not the perspective of the purchaser. A purchaser is going to be interested in the business model canvas, the sustainability of the industry. This was one of those 4 quartiles you might remember, and in terms of explaining what's going on, this would be up front and center as far as I'm concerned. Growth is good. Repeatable business is good. Recurring incomes are good. Switching costs, which prevent people moving away, are good. So when you are devising the business model, and in particular you are looking at the nature of revenue, do think about this. I thought it might be a little bit of fun, just for a few seconds, indulge me, I'm an accountant, to look at some incredibly complicated numbers that are going to leave you all reaching for the aspirin bottle. But don't worry too much. It's not so bad. The question is, why grow? Well, maybe you can have a 4th holiday. Maybe you can have a bigger car. There's got to be more to life than that, surely. I think there is. And here we go. What this says is that if you get $2 every year going forward, what is that worth to you? A simple perpetuity formula. And here graphically, here's our $2 a year going forward, but actually tomorrow's money is not quite worth as much as today. And so the value diminishes. You'll see the point of this in a second, I promise. And the value comes out at $20. Remember that one. No growth, just $2 a year going forward. Compare that to a growing perpetuity formula where the income grows at 5% a year. So here we have our $2 now growing at only 5% a year, our profitability, if you like. What's it done to the current value of this cash flow? It's gone from 20 to 40. Straightforward maths, a 5% increase in profits year on year mathematically leads to a doubling of current value. That is the kind of thing that a purchaser is interested in. That is the kind of thing which builds shareholder value. The next one down, good organizational management. Believe it or not, McDonald's is a great favorite of mine. I think it's a fantastic company. Not entirely sure about the food, but if you're desperate, it's okay. The words here are, it's actually an Israeli sign. But the interesting thing about McDonald's from my point of view is that you can go into a McDonald's pretty well anywhere in the world, certainly anywhere in the UK and Western Europe, and you know exactly what you're going to get. To build a business that size that operates within those parameters and those margins and to produce continuity of quality is, I think, really very exceptional. I know businesses, local businesses, businesses throughout the Southwest who open a second branch. And the moment they open a second branch, might be in the next village, town, city, maybe only 10, 20 miles away, suddenly the whole thing goes out the window. Controls go wrong, delegation doesn't work, the owner is running around between the two sites. It's a complete disaster. McDonald's managed to turn out a really consistent product. So when a purchaser, and if we're building value, let's look at it from a purchase point of view, is considering whether we've got shareholder value here, he's going to look at how this business would continue to generate profit and cash if the existing management and owners exited. I'm going to come on to management structure later, but it's a really, really important consideration. The growth strategy. Here we have a load of business model canvases going into my money factory. And this is a company. And it's a company which takes ideas and customers and value propositions, and it turns them into cash. Now, as an investor, I really don't care whether we're importing bananas or selling apps or whatever we're doing. What I really want to do is process these opportunities in the most efficient way. And because things change, everyone's seen the product life cycle, because things change, you've got to have more lined up. So a purchaser who's looking at things from a different perspective is saying, well, things have gone quite well so far, but where next? If you look at Google as an example, you've got the iPhone that came in, then we got, great market share and stuff, then the iPad, then the iWatch and all that sort of thing. With the market cap, which Apple has, you've got to ask yourself, how are they going to maintain that value? Microsoft, interestingly, has 30% approximately of its business, of its revenues, and actually a slightly higher percentage of its profits from its server products and cloud services. Now, everybody thinks of Microsoft, everybody thinks about Windows, everybody thinks about Office, and of course they're in the mix. But Microsoft have looked at their strategy and they have decided that there are other things they can address, and those new items have now grown to become 30% of their business. So a purchaser is going to look at the ethos of a business, of the way it deals with change, of the way in which it addresses value creation and different models. Evidence-based growth strategy, measuring performance. Back to Mayura and his traction statistics. People who know their numbers, people who know how their customers make decisions, people who know how their customers are being satisfied, their churn rates, people who understand that tend to run very good businesses. So in putting the strategy together, these kind of metrics are very, very important. Vision forward. This was a slide from last week. Let's find my notes. A lot of people have quite a good idea of where they've come from, possibly financially, although a lot of people don't produce accurate management information. But both in terms of strategy and finance, when they turn around and they look through the windscreen, it's a very different picture. On the left, we've got clear financials on the way forward with good projections, good understanding of cash, good understanding of strategy, if you like, new developments, new business models. On the right, no idea. If you are looking to invest in a business, what do you think we are interested in? Here we're looking at this in a different way. Now we've got an investor. An investor is looking at this business as a vehicle which is going to spin off profit and cash and grow. They're going to be incredibly interested in the view of the customer, of the marketplace, of their reaction to what is happening. And they may also be interested in their view of what happens if ownership changes. Ethos may change. Growth, emphasis on growth may change. Chasing of cash may become more aggressive. So each time we look at a different concept, potentially there are stakeholders who have a different perspective on life. And we've talked about investors. If you look at a classic equity play, shall we say, you've got an investment here of 1 square. These are years, and our investor, our VC, our business angel, whatever, puts 1 in here. And under the classic model, 5 years later, typically they are hoping they might get 5 times their money back. Potentially, they may get 10 times their money back. This has an enormous impact on the way in which they look at the business model and the business. Our team are perhaps thinking, yep, we've run a good ship, we make good profits, we got good cash flow, we're doing quite well. The customers are reasonably happy with what's going on. The investor is thinking, am I going to get to this? No, I'm not sure. So by putting ourselves in the shoes of the people on the other side of the table, be it Innovate providing grants, be it banks, be it investors, business angels, purchasers, whatever it is, do try to look at things from a different perspective. And maybe one of these colors should be for a non-exec chairman, something like that. Somebody, a mentor, somebody who can work with you to draw attention to the fact that the team don't necessarily know it all. I'm going to do a couple without slides. Short-term cash management is critical. Longer-term profitability, early stage businesses when they are developing products, or existing businesses developing new products, sometimes that sucks cash out. It can be done. Think Amazon, lost cash hand over fist for many years, eventually tied to a longer term profitability. And if you ask me which of the big four might come out on top in the end, I'd be very tempted to say that I thought Amazon might just be that player. Justified expectation of efficient future profits. The rate at which you convert revenue to cash and profitability is particularly important. We're going to look at return on capital employed shortly. IP protection. There's already been a number of programs in this series which have looked at IP. It's a bit of a mixed bag in my view. Certainly building brand adds shareholder value very well, and trademarks can be very powerful. Patents are very expensive, and they are particularly expensive to defend if somebody comes along and pinches things. So where are we with patents? Well, it's a cure its egg, and it's very much a strategic board decision. There is no doubt that if your strategy is to build and sell this business, or to build the business to a point when a VC will come in, then IP will add significantly to the shareholder value, because those guys will facilitate the protection of the IP. But in the short term, it's a heavy cost. Spiders' webs and delegation around the team. Building shareholder value does not require an organization chart that looks like this. This is the antithesis of an organizational structure that creates value. We've got one person sitting in the middle. Donald Trump is a very good example. And you've got all the people around him in all the different departments, or you've got a very headstrong CEO, a founder, somebody who is running a business, and guess what? Everything goes through them. So let's say, go back to our colored traffic lights, our perspectives. I'm coming along looking at investing in this business or buying this business, and I think, what happens if the guy in the middle goes? What happens when they leave? And the answer is, well, the whole thing might just fall apart. So back to McDonald's, really? Have we got an organization which will survive a transfer of ownership? Is there a transition between management and ownership which will make the building of value effective? When you are thinking about strategically building the business, do think about that. And it's also the case, may I say, that if too much has to be channeled through one person in the middle, then that itself will be a limit on the growth potential of the business. Now we're moving on, so we're coming on to the last bit, a little bit more maths to send you away happy. The secret of life, the universe, and all things financial. What is the single most important measure in business? And it's return on capital employed. Hooray! Which is how much profit you make out of how much capital is taken up in the business. It's a bit like saying, how much interest do I get from various banks or building societies or ISAs or whatever else? And you can break down the basic formula by looking at two ratios, two percentages. The top one up here can be broken down into your profitability multiplied by how effectively you turn your assets. This is something which a lot of people don't necessarily consider, but it's how often you spin your cash, your capital employed in the business. Interestingly, these two cancel out. Go back to basic maths. You want to simplify these two fractions. Sales here cancels with sales there. So building sales is not going to affect this ratio. You will not make a better return on capital employed by having more sales. It cancels out. And here's two examples. Tesco, big business, this is a few years ago, but the numbers are right. 20% return on capital employed, made up of 8% is their profit, bottom line profit margin, and turning their assets 2.6 times. If you multiply those together, you come up with 20%. Aldi, another multiple retailer, multiple grocer, also 20%. Also 20%, the same as Tesco, but look at the difference. Tesco selling at that time all sorts of stuff around the edges and generally making more money. Aldi, bottom line basics. But look how hard the two businesses make their assets work. Tesco only turning their capital 2.5 times. Aldi, it's spinning round. The stuff is flying off the shelves. This is a more efficient business than this. Tesco's numbers, I may say, have now changed. They've seen this coming. You will be aware that Tesco don't sell as many lines, as many sort of peripheral things as they used to. So it's 9:30. There we are. Those are a few thoughts to share with you. It's been a really quick canter through. I've referred to some books. We'll try and make sure that those are made available to you. I hope the maths has not been too off-putting. Thank you for participating.
Thank you, Phil. Very interesting. I think there was quite a lot to digest. if you were new, or you're just changing your thought to understand a bit more of your exit strategy with your business, or just looking at how you can prepare yourself for some kind of investment in, which area would you go to first on that list, that busy slide that you put up with the list on there?
Okay, I think that's well, it's a good question. The simple answer is I would go to the business model first. And as part of that business model, you've got the value proposition as a subset.
Yeah.
The first question that an investor or a financier or a purchaser looks at is, do I get what this company is doing? Do I understand how they make their money? And do they understand how they make their money? Because some people manage to make money and not really quite understand how they manage to get there. Doesn't happen very often, but it can be the case. So I would suggest getting the business model correct, seeing it from above and below. I've gone big today on these different perspectives, taking advice externally, perhaps to open people's eyes to how somebody else might view it. That's where I'd go first, Tara.
Okay, brilliant. If you have got any questions, do pop them into the Q&A. There was a question about one of the books, so yeah, if we will send out a little list of the books that have been referenced today. Good bit of Christmas reading if you're looking at doing that. Yeah, really on that side, I think, unless any more questions come in, we'll have a go on the Slido and to get some of your feedback. We've been doing this for the last couple of webinars, where getting some interactive live feedback from you all. So just waiting for the slide deck to update. There we go. There's a QR code in the top left of this slide. If you point your phone to it, an option should come up with regards to answering the questions. Alternatively, you can go to the website slido.com and enter the code in there. And just pop in what you found really beneficial. While people are doing that, I've just had a question come in, Phil.
Okay.
How is capital employed calculated, and how to forecast?
Okay, that's that's not one that we're going. That's not one we're going to deal with here. I'll have to deal with that offline. But essentially, you are simply dividing the profit you get by the amount of money you've put into the business. Okay. Very similar to, as I said in my presentation, if you have got £10,000 to put in a bank, what rate of interest would you get? What would that generate per year? If you're going to put £10,000 into a business to start it up, what's it going to generate for you? What's it going to generate for the shareholders? And at its simplest, that's all it is.
Brilliant. Okay. So the first question, we've had a few answers go up. It should automatically trigger to question 2 when you've answered question 1. And there's 3 questions that we're covering on this Slido poll. So here we go. And then the final one is probably the more crucial one for us as we're coming to the end of this series. We'll be looking at delivering some more webinars, masterclasses and content in the new year. We'd love to know what kind of content you would like us to deliver. If we hit the spot on this series, is there some new stuff that we need to look at? Is there partnerships we need to kind of go into? So yeah, getting the feedback from the businesses attending is quite crucial for us going forward. Okay, I'm just going to wrap up now then, because I can kind of see numbers dropping off. Thank you, Phil, once again, very insightful. Definitely a lot of food for thought with regards to what shareholders and investors are looking for within your business.